So what we're going to go through now is the absolute basics of home loans in Australia. So in Australia, when you apply for a home loan, the loan is advanced by either a bank or a non-bank institution. So the loan is actually secured by a property. So we never do loans that are unsecured. So what I mean by secured by a property is that if the customer doesn't pay back the loan, then the lender has the right to sell that property. They can take possession of that property and then they can then sell it. And that's the alternative way of repaying the debt. So you can have one loan secured by multiple properties. That's okay. So home loans in Australia, the vast majority of people in Australia have a variable rate loan, which in America is known as an adjustable rate mortgage or an ARM. But in Australia, we call it a variable rate. This means that the interest rate can change if the bank's cost of funds changes, or if the Reserve Bank of Australia changes interest rates across the entire country, then that interest rate can change. Most loans have a term of 30 years, which means that people repay the loan over 30 years. But most loans in Australia, you have a lot of flexibility. You can repay them earlier if you like, and as a general rule, there's no penalty to do so to the customer. So if they want to pay it off over 5 years or 10 years, they can do that. They can do that by either calling the bank and asking for the bank to increase the size of their repayments, or they can just manually pay in repayments, because each loan has an account number, just like a check account or a savings account, so you can just transfer money into it. It's very simple. So if you pay off the loan earlier, there are no exit fees to pay off the loan. The only exception is with fixed rate loans. Most loans have what's known as a redraw facility, which what that means is that if you've got a loan of $100,000 and then your parents give you, say, $50,000, you can pay that straight onto the loan, and the redraw facility allows you to take it back at a later date. So it means then you can save interest on your loan by putting that $50,000 into the loan, and if you need to buy a car later on, you can take maybe $10,000 back out to buy a car. So it's very, very flexible the way that loans work in Australia. You can have a loan which has multiple loan accounts. So maybe if you have a home worth $1 million and you decide to borrow $800,000 against it, and you're using $100,000 to renovate your home and $700,000 to buy shares, then you may decide to have two loan accounts. So it means they have different account numbers, and for all intents and purposes, they're like two separate loans, but it's secured on one property. And the reason you would do that is so that when it comes time to do your tax, you can very clearly show the government, I paid this much interest for that $700,000 which I used to buy shares, and they would allow you to tax deduct that, because that was money that you borrowed for investment purposes. So it was money you borrowed to try and make more money. Whereas the money that you borrowed to renovate your home is not investment purposes, and you can't tax deduct that. That's the absolute basics of home loans in Australia. So that concludes the training for today. What you should do now is, if you've been given a handout, please complete that handout and return it to your supervisor. Also, if you have any questions, please refer them to your supervisor as well. Remember that training is your responsibility. It's very important that you go over this training session 2 more times, ideally 1 day from now and again a week from now as well. That way then it'll stay in your memory.